Welcome back everyone to the Money Control live stream. You're watching markets with Santo and CJ. Well, the resistance of the bulls did not last that long, Santo. After all, after the very strong start we saw in the morning, we have given up all of those gains and are now sitting almost near the day's low at this point of time. If you look at the Nifty and the Sensex, they are looking set for the second consecutive day of losses. IT, pharma, real estate firms, they were the major laggards as far as sectors were concerned. And if you look at the futures and options market, clearly a lot of build-up of short interest, Santo.
Well, yeah, given that the market had been rallying for so long, CJ, it's not surprising that we could see a couple of days of correction. And also, let's not forget the mood in the global markets, which right now is a bit iffy at this point in time.
Very skittish.
So, yeah, so I wouldn't read too much into this at this point. At least the outlook is positive. But one thing I would be a little cautious is that you're seeing again a frenzy kind of build up in the small and mid cap stocks. That segment has been almost on a one-way street, even though the broader market is fair, the main indices are weak. You're seeing fair bit of strength in the second line stocks, and that I think sometimes is an indicator of caution. We had seen something similar last September, October also, when you had seen that huge build up between the second week of September all the way till the third week of October. There was a kind of frenzy, and almost it's like a deja vu, I would say, CJ.
I think, Santo, but if you look at the performance, I mean, clearly Nifty Mid Cap 100 index is higher by about 0.6%, and Nifty Small Cap up about 0.2%. So clearly, retail investors are now back in the market. And I think one of our viewers also asked this question that whether retail investors can be considered on par with FIIs and DIIs right now. And I think over the course of the past 1.5 years, I think retail investors, even though they only account for almost 9% of the overall share of the market, I think they still are exhibiting a lot of power, at least on the downside, where they seem to be acting as a major support for the market.
Well, occasionally, yes, fund managers lose their shirt to retail investors, but often if you look at over the longer term, mostly it's institutional investors who manage to survive. Yes, the trend has been slightly different over the last couple of years. We have seen very strong retail participation, but I would still put my money on institutional investors.
Yeah, of course, smart money is smart money. You can always say that, but of course, I think retail investors would be happy to lose the tag that they are dumb money anymore. I think that
earlier that used to be the case. They would say that whenever you see retail coming in, that's the time to exit.
But
so now that doesn't hold true.
I think that it does not hold
because
true.
you have about a good amount of money coming right through the SIP route month after month, right? So
absolutely.
That itself means that you can't really ignore retail investors anymore. They are now a regular participant, not the kind of investors who just come in when the party is almost about to get over.
Yes. That said, let's quickly now move on to some of the stocks that were buzzing in trade, and the first name from Santo is
CEAT. And CJ, spectacular rally in the stock today. Huge gains, almost 18% up. No fresh triggers there. Overall, the sentiment for tire stocks in general has been pretty good over the last couple of months. Couple of factors here. Again, I've said this in the past also. Crude oil prices have come off their highs, and also you're seeing rubber prices also cool off. Now these two together account for a significant chunk of tire companies' operating expenses. So there's a big relief. The raw material costs coming off very significantly, plus the change sentiment for auto sector. Now CEAT is trading at a market capitalization of less than 1 time its annual sales. It's not the only company. If you compare it with MRF trades about 5 to 6 times.
Right.
Apollo Tyres also trades less than 1 time. Now there is a reason for this, and according to analysts tracking the sector, it's mainly because of the weak margins compared to some of the other players. Now to offset that, CEAT is now trying to step up its presence in two-wheeler as well as off-the-road tires. Off-the-road tires in particular, that's where the big margins are, and also passenger cars. Besides that, CEAT has been investing heavily in capex over the last couple of years. Now that was also one of the reasons for the pressure on margins, and now the capex is almost coming to an end, and now you could see the results of that slowly flowing into the bottom line. So a lot of changes happening there. Besides that, it's aggressively now getting into it's increasing its marketing spends also. That is also one key area for tire companies, and that does tend to make a difference. So the company is doing quite a few right things at this point in time, and you're already seeing it in the stock price movement. Big rally there. It's almost now more than 50% in the last couple of months.
I think, Santo, the rally has been in tandem with what we are seeing across the board in the automobile as well as the auto ancillary space. So clearly, they have floated in the same boat as far as CEAT is concerned. But I just feel that overall market has been very optimistic that automobile volumes across the board, from passenger cars to commercial vehicles to two-wheelers, are going to be seeing a big rebound in the coming months and years ahead. But I just feel that so far, if you look at the retail sales data that FADA releases, clearly two-wheeler is one segment that is lacking the zing that probably the passenger car segment is showing at this point of time. And I think that makes me a little skeptical that the volume upside for CEAT going ahead could be a little limited, at least in the next couple of quarters. Maybe the picture will turn around next year, or maybe after the festive period. We will have to wait and see. But at this point of time, it does not look like retail sales are going to pick up. Although companies have tried to fill in channel inventories, once that if that inventory doesn't get sold, then in the future you will see that wholesale volumes will come down quite automatically. Apart from that, if you look at the technical indicators also, despite the 50% sort of gains, Santo, I mean, if you look at the short-term technical indicators, it just suggests that there is a lack of momentum at this point of time. It seems like the stock is, probably in a no man's land at this point of time, wherein it does not know whether it should see a bit of a profit booking or whether it should, see the next leg of rally. So I think at this point of time, because there is no obvious direction as to where the stock is going, probably it will not be the best time to enter this stock. Also, it is facing a very stiff resistance around the 1420 level, and that will be very crucial to see. If it can cross above that level, then probably it will be in a new territory, and therefore one could look at more upside. But at this point of time, that would be one level where you could see some profit booking.
Well, next stock on your radar?
Well,
CJ?
the next stock, Santo, is actually one of the stocks that you have been talking about in the past, and that is ABB India, clearly a beneficiary of the markets believe that the capex cycle is now quite firmly underway. But a very interesting report came out from brokerage from Kotak Equities today, and they are of the view that the stock is likely to enter a consolidation phase over the next 12 months because of the rich valuations. They have downgraded the stock from an outperform rating, AD rating actually, to a reduced rating. AD is almost equivalent to an outperform rating by their rating standards. So clearly, they now believe that given that the stock is trading almost 63 times 1 year forward earnings for a capital good company, at this point of time, it does not look like there is much re-rating left to be done. Now, I think what investors will want to see is execution on the optimism that has been built into the stock price. And if the company fails to deliver, therefore, you could see major downswings in the stock. And this is something that happens across market cycles. Investors will first build in the expectation, then they will wait for the delivery. If the delivery does not match the expectation, the downside becomes very apparent. And apart from that, another major part of business for ABB India recently has been the export side. I mean, capital good exports had really picked up in FY22 for Indian companies, but given the concerns around global slowdown, yes, the domestic market might do well, but if the global slowdown fears do materialize, then exports orders or export side of the business could suffer for ABB India.
Well, you have a fair point there, CJ, but if you look at the order flows for the first couple of quarters of this calendar year, ABB follows the calendar year. In quarter 2, order inflows were up 64%. And for quarter 1 and 2 put together, it was up something like 44%. So far, you're not seeing any kind of slowdown. This is something that all capital good companies have been saying, that the order visibility is pretty good. And then look at the order backlog also, close to about 6,000 crore worth of orders are still to be executed for ABB India. And most important thing is that across all its key verticals, if you look at process automation or motion business or electrification, all 3 segments saw decent order wins and from a wide range of industries. So it's not as if they're taking any concentrated bets at this point in time. I would not be so skeptical on that. On the last point about expensive valuations, now if you look at a stock like ABB, it's always been trading at a high multiple. That's always been the case. There's never a time when you could get ABB or Siemens really cheap, except maybe back in the late 90s or early 2000. Otherwise, they've always been fairly
But
expensive.
I think there has been a decent amount of re-rating in the stock. I mean,
It's
in the
already
past
been, yes.
1 year, there has been a decent amount of re-rating, and there's only so far that re-rating can happen. It cannot continue in
True,
perpetuity.
I buy that point, CJ.
Well, Santo, next stock on your radar?
Again from the capital goods
Yeah.
segment, it is Honeywell Automation. Now, this is a play on the process automation business in the domestic market. The stock has done pretty well, and what the company is trying to do at this stage is also that so far bulk of its order, the major clientele has been from the oil and gas sector. It's now trying to reduce its dependence on that segment, and it's trying to move into other segments like building automation, smart city solutions, and cyber security. Now, according to ISEC, Honeywell Automation has longer cycle orders when you compare it to its peers like Siemens and ABB India. And the other good part about Honeywell Automation also, CJ, has been its balance sheet. It's pretty lean, very little borrowings, and also it's got cash of about over 2,000 crores. So the stock has seen a fair run up. Now I don't know how much it can really go up from these levels or really build on it. However, this is a stock which clearly will continue to outperform compared to the rest of the market.
Well, Santo, if you look at, for all that optimism, if you look at the past 6 months performance in the stock, it has only risen about 6% in the past 6 months, clearly underperforming much of the broader market and even many of its peers in the capital goods segment. So there is clearly some bit of skepticism that the market has with respect to Honeywell Automation. Yes, it is supposed to be a beneficiary of the revival that people are talking about in the capex cycle, but as a technical from a technical charting point of view, it does lack a bit of a price momentum at this point of time. If you look at some of the momentum indicators such as MFI or RSI, they are clearly not at levels where it will inspire confidence in you that the stock is in an upward trend or that it's a trending move that is taking place in the stock. So for that reason, I think I will probably be a little skeptical as to whether there is scope for much upside in the stock, but we will have to wait and see how that transpires. You never know, with the second quarter earnings season now just weeks away. Probably with the earnings season coming up, if the earnings turn out to be very strong and the commentary turns out to be very strong, maybe the stock will get out of this no man's land and maybe start a new up move. Well, the next stock on my radar today is from the telecom space, Bharti Airtel. CRSA came out with a very, very interesting report on the 5G rollout, and their opinion is basically that the stock is going to likely gain some traction. Now, Bharti Airtel has been, sort of in a silent period, if one can call it that. The stock has not really, neither it has underperformed nor has it outperformed over the past 7 to 8 months. But clearly now, as we near the launch of 5G services, you could expect a stock like Bharti Airtel to be much more in action. CLSA expects that the 5G services, in addition to the 4G services, is going to boost the EBITDA of Bharti Airtel by as much as 20 to 23% annualized growth going ahead. So that is clearly a very, very big positive as far as the profitability is concerned. Apart from that, clearly Bharti Airtel and of course Reliance Jio of RIL are expected to gain further market share from Vodafone, because at this point of time, it does not look like Vodafone can compete with these two bigger rivals as far as the capex is concerned on the 5G front. For CLSA, clearly Bharti is the top pick in the sector, and they believe that the upside on the stock over the next 4 to 5 years is too good to ignore at this point of time.
Well, very hard to argue against Bharti as far as fundamentals go. Clearly, it's a near duopoly market now.
Yeah.
There are 3 players, but we all know who the 2 big players are, so no disputing that one. The only thing I would say at this point in time, it seems to be too easy a story to make money on, right? If there are only 2 players, obviously they are going to do pretty well, and it's again, both are almost equally strong at this point in time. Fairly, it's a neck and neck race at this point in time. So if you look at Bharti, the biggest thing in favor of Bharti was that India is an underpenetrated market for telecom. I'm not sure now if we can say whether market is really underpenetrated at this stage. Now, what companies like Bharti will have to do now is to improve its realizations, because if you look at the top line over the last 10 or 11 years, it has doubled. Of course, margins have gone up fair bit.
Yes.
It was about 34% operating margin back in 2011.
ARPUs have gone up almost 40%, 45%
Yes.
in the past 3 years alone.
Yes, and now it's risen to about, the margins have risen to, gross margins have risen to about 50 odd percent.
Yeah.
So there's an improvement there, but at the same time, you should also keep in mind the fact that this is a very, very capital intensive industry, and if you again look at the borrowing costs, the debt on its balance sheet has also risen considerably over the last 10 years.
Well, Sandro, on that, CLS has this point that because Bharti is going for a non-standard standalone 5G network, it will be utilizing its existing 4G to provide the 5G network, and therefore the capex for Bharti in that sense would be much lower, say for what Reliance Jio is planning. And Salus is of the belief that the business will be able to sustain, generate so much cash that they will be able to invest in that capex and also pay off debt without hurting their margins or anything like that. So I think that is the confidence that CLSA has at this
Well,
point.
interesting, but then telecom always traditionally is a capital intensive. You might skip it this round, probably you might not need so much of investment, but going forward that's always been the case. We have seen that over the years. So I'm of the view that probably yes, this is a good stock, but will you make huge money over the longer term since the story is already well known? Let's see.
Let's see. Anyway, last stock on your radar today?
Infra, again, a lot of action in that stock over the last few months. CJ, what I hear from the market is that it's largely HNIs which are driving the stock at this point in time. Very little institutional interest. We all know it's troubled past. Now, one of the things that has got market excited about our infra is that it had won a arbitration order against Delhi Metro Corporation for 6,300 some time back. And after that win, it is now locked horns with the Adani Group. It's filed 13,400 crore arbitration, right? And the market seems to be expecting that it will probably be in its favor. And if it comes through,
well, if it comes
definitely
through, it'll be great.
great. But Adani Group is not giving up without a fight. They've already said that they have raised some counter claims on their own. We still don't know what the dispute, the heart of the dispute is. It relates to the transfer of our infra's Mumbai transmission business to
which Adani Electricity had bought.
Adani Electricity had bought. So there's some dispute in the shareholder purchase agreement. That is broadly what the issue is about. But Adani Group has clearly mentioned that this is they filed the suit sum as an afterthought, and initially the claim was just for about 500 odd crore. So this is going to be a very long drawn battle. In the meantime, if you look at the top line trajectory, well, there's some bit of bit of uptick there, but again you're seeing a lot of volatility in the margin. This is not really a fundamental story is how I would put it. It's largely a hope story, hoping that the company might win another arbitration order in its favor.
Well, Santo, and that is where most of my skepticism lies, because I believe that the up move that we are seeing is most likely to be utilized to realize gains later on, because in this stock you have a lot of involvement from speculators. You don't have a lot of long only hands or very strong hands in this sort of a stock. Generally you would find a lot of speculators on this counter, and you can see that in the delivery volumes as well. Delivery volumes have really not risen too much, far ahead of a 1 month average or a 3 month average, to suggest that long only hands are coming into this counter. And therefore I think for me, yes, tactically you can play it from a short term perspective, but you will have to be very, very careful in terms of timing your exit or timing your entry into a stock like Reliance Infra at this point.
Yes, and with that, let's quickly take a look at the market. I think the weakness has intensified a bit since we last spoke.
Yeah, I mean we are down about 0.7% on Nifty, so almost 0.2% or 20 basis point down move on the Nifty. If you look at some of the sectoral indices, Santo, clearly IT is the one that is taking the biggest hit. Nifty IT is down about 1.4%. Nifty Realty down 1%, and Nifty Bank also is now edging towards the day's low, down about 0.5%. So clearly some bit of profit booking, some bit of unwinding of long positions also happening, because today is the weekly expiry as well on the Nifty. So that was something that will also play a role in terms of how traders are positioning themselves. But clearly, it's the broader market where most of the action is. The mid-cap space, the Nifty Mid-Cap 100 is up about 0.3%, while the Nifty Small Cap has almost now turned into the red after almost staying in the green for most of the session.
And with that, what is it that we are looking forward to, CJ?
Well, Santo, data points basically, I think two key data points that will be coming out in the US in the evening. The retail sales data for the month of August will be coming out, so that will be very important to watch in terms of how inflation is impacting consumer demand in the US. And apart from that, the initial jobless claims data will also come out to give an idea of how the labor market is. Remember, the Fed has said that they do not consider the current downtick in GDP to be actually recessionary, because the labor market is just too strong, and therefore in a recession labor market cannot be strong, and that will be counterintuitive, right? So therefore it will be very interesting to see how these two data points come out and how the market reacts to them, because we have seen the sort of impact the inflation data had for the month of August.
Well, Fed certainly does it have its hand full. And with that,
True.
it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching as always. And please do share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, I don't need to say it. Stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live tomorrow morning at 9 a.m. Till then, have a great day.